Welcome to our global market forecast brought to you by Options21 with special focus on global indices. In the months gone by, we have observed the S&P 500 do a large fall, a large capitulation into early 2019 and then a large rally. This large capitulation and rally equates to a pattern called an inverted head and shoulders pattern. An inverted head and shoulders pattern is an accumulation pattern which sets the market up for the next expansion. For the expansion to be intact, we need to observe a series of higher highs and higher lows as the market continues to the upside. Pullbacks are acceptable and continuing rallies are acceptable, but what is unacceptable is what's just happened in the previous session. That is, the market broke what is called a low or a swing low in the market, and that break of that particular previous low negates the trend. So, if you were to ask me, is this accumulation phase still intact for a large expansion? The answer is no. And the trend officially, as of last night, is down. Now, people that I deal with, we watch this every single day, and in the past weeks, we have, or the past week at least, we have exited or reduced any risk within our portfolios, either through hedging or going to cash. But that would be the absolute, I suppose, nail in the coffin. If you were still of the belief the market's going up, that's not a true statement, technically. For you to rejoin in this market and be fully committed into the S&P 500, this particular, this market now has to fall. But at the absolute minimum, it needs to go through an accumulation phase, and that's not what's occurring on screen. What's occurring on screen is a distribution phase with something called a confirmed M top, and the market will continue and it will reach a level where it'll start to accumulate. The question is, which level will it get to? Where is this market going to get to? The best way I can describe to you where a market normally falls to in the context of a large, well, it's not a correction, it's still just a pullback at the moment, is to divide the previous range from early in the year to its recent highs and divide that range into its Fibonacci components. Markets often fall and reach one of these levels. So often it's not 0.25 where it is at the moment. It's not normally 0.382. It usually gets back to 0.5 or 0.618. At one of these levels, I would be very, very closely examining the chart for pattern behavior, volume, and accumulation patterns and breaks of trend, and analyzing, the next bottom in this particular indice. I will point out that the recent top is happening or has occurred in the context of a fairly large increase in the fear index called the VIX, which is a very excellent early warning indicator of a market topping. Just coming back to the S&P 500 for a moment, for a market to have a really good pullback, even a corrective phase, we need to have fundamentals that are driving it. I think there's two fundamentals which are probably driving this market. To a lesser extent, Brexit and the resignation of the UK Prime Minister and the possibility of her predecessor not having the capacity to achieve anything more than the current Prime Minister was able to. And that would lead to what's called as a hard Brexit without an agreement with Europe. That is an issue, and that is a possibility. The other large global macroeconomic fundamental, which is the big one, is the tariff discussions between the United States and China. Justified or underjustified, that is going to continue, and as it continues, until an agreement, until the two parties come close to an agreement, it will have negative implications for global growth and negative implications for both the two biggest economies on the planet. There is collateral damage, and the collateral damage are countries that are extremely dependent upon China for their growth. And I live in one of those countries, it's Australia. So we are very dependent on our domestic growth due to our trade with China. That's our biggest trading partner. So, this is not something that is not closely watched by the whole world. And we would love to see, I suppose, a resolution in tariff agreements between the United States. The markets love certainty. They don't like disagreement. And we'd like to see that occur. It'd be great. And then we'd see a resumption of a potentially upward moving index and upward moving global markets. But the longer that goes on, the more damaging it will become to global growth. I think it's important to have a viewpoint of all the indices around the world. Some of these indices I'm using exchange traded funds as a representation, and the one I've got up on screen is EWC, which is the Canadian indice, which we can see last night. It's just at the point of breaking its short-term trend and closing below its previous swing low. As already stated, this is not unimportant. This is actually very, very important because it's confirming in technical terms what is an M top in the market. And M tops are technical patterns which confirm distribution, which is selling behavior within the market. So that occurred last night. It's a break of trend and a close below the previous midpoint, which indicates a top. You can't go long in this particular market until exactly the same with the S&P 500. It goes through accumulation, and that's not going to be for a while. Let's jump across the ditch to EWG, which is the exchange traded fund representing Germany. And as we can see in the past week, the market had been trading slightly below its trend line, but now there's a confirmation of a break below the trend line with what would be described as a lower high on screen. So it was still intact till just last session, where now we've got a high, a lower high, and lower high has been confirmed by a close below the midpoint. This is the definition of a break of trend. This is the beginning of a trend to the downside, and I'll keep on saying it. The only way you can go long is in the future when we start to talk about accumulation, and accumulation is recognized and complete, then we can go long within this particular chart. Jumping across to actually the DAX, and it's a very similar picture where for the first time we've got a break of trend last night. This is still intact last week. It has done what is a confirmed lower high, which is described as an M top, and that is confirmed break of trend. So once again, same story. It needs to continue onto the downside, accumulate, and then, and only then, at that point, could you consider going long this particular market. Jumping across to China, we can look at China through the exchange traded fund called FXI. Top, I think, 25 capitalized stocks representing this ETF. This is just in free fall at the moment, and there's nothing on this screen which surprises me. The Chinese have been heavily impacted by the discussions of tariff agreements, and will continue to do so into the near future until an agreement, hopefully, I think in the not too distant future, there's a G20 meeting, and at that point we may get some sort of resolution, or a narrowing of differences is all you need to get positive impact on financial markets. They're just looking for certainty. If we jump across to the Shanghai Composite, it also is in free fall. Just give me one moment. I'm going to clean up my screen. Looking at this particular chart in a little bit of detail, it's the Shanghai Composite, which has obviously had an extremely nice rally, and as a result again of the discussions, has been pulling back, and it looks like it's been building a nice base here. The only problem with that base is is it looks like it's about to fail, and that's very important because failed patterns often get extreme reactions. And if I was to analyse this in the context of recognising a pattern that could be potentially useful, maybe I would say this is a W pattern with a test and retest, but accumulation patterns in the context of W patterns are not valid unless they cross their midpoint, and this hasn't crossed its midpoint. And when it doesn't cross its midpoint and fails, what normally happens is a large capitulation. Now, I cannot see into the future, but often what happens is what happened on the S&P 500. You get failed W patterns, large capitulations, then large rallies, and then the market stabilizes and goes up. So let's not pretend I can see into the future. I can't. All I can do is analyze the present. And what I would be analyzing in the context of this particular chart is the potential for, for this to occur. And we'll nut this out in the next week. So China, if you were looking at this, the Chinese market to go long, that would not be the right thing to do at the moment. And if this pattern that has half evolved does fail, you could see rather a large capitulation. For a large capitulation to occur, also it has to be driven by something. So there'll be some sort of disagreement, some large negative, some adverse tweets from the White House that will really dampen down the chances of a close near agreement with the United States and China. But just look out for that, because that's what will trigger it. It hasn't occurred yet, but the market is quite weak. That whole situation is very weak. I think I jumped over the English chart, and what we can see since April, late April, that particular indice using the exchange traded fund to represent the United Kingdom, EW user code, has been falling quite strongly. And I believe with the destabilisation of the government, they've got prime ministers resigning, as already stated, new prime ministers that may not be the best to resolve such complex issues. If it leads to a hard Brexit, the United Kingdom, the charts really factor in weakness. So this is probably the worst chart that I'm looking at, and it continues to forecast ongoing large falls within the UK. The last chart I'll look at today is the Australian Asia-Pacific, back to Asia-Pacific Australian chart. First of all, EWA, which is the Exchange Traded Fund. I can't get a lot of information out of this chart. It is quite bullish, and it made a new high in the last few days. I think probably what's best is to actually look at the actual ASX S&P 200, which is the Australian indice, and let me just blow it up a little bit. So what we can see on screen is a M-top. This has just occurred in the past 3 or 4 days, and officially we have a high which didn't take out the previous high, and then it crossed its midpoint, which is the confirmation of an M-top. So another observation to be made is the previous range to the upside is, I believe, exactly the same or very close to the current range to the upside. Markets often reach 100% of previous ranges, and then they start to distribute. That's exactly what happens. Why? I don't want to even try and think or explain, but it's an observation of a consistent pattern occurring within these markets. Let me just shift to a different viewpoint. Instead of looking at expansions, let's look at pullbacks within this market. Now, looking at the market in the context of a pullback, let's have a look at the first range that I put up on screen, and I'm simply dividing the range into its Fibonacci components. And what you'll notice is the market pulled back to 0.618, and then it found support, and then it bounced. That support level on 0.618 also is sitting on a long-term trend line, which I haven't drawn. Just accept that as a true statement. So just keeping that in mind, let's do the same thing with this particular range. and we can start to put up targets of where we expect this market to get to. As this market falls, I would be extremely focused on 0.618, and that would be a level where I would expect potential support to come in. And I'll be looking at volume patterns, accumulation, and getting ready to go long the market by buying shares. I just want to put back in that long-term trend line, that is the trend line since early 2019, just drawing it up the screen, and I'll bring it back to a daily chart. I just want to make the point that on the last pullback, remember it pulled back 0.618, it found support at that line, and most interestingly, as I continue that trend line to the upside, 0.618 also coincides with that line. Therefore, it would be a point of focus. You know, trend lines and Fibonacci's are just tools. They do not predict anything, but they tell us when to focus our attention. If we're looking for a re-entry point on screen, that's what we should be doing. Okay, that's it for this presentation. If at any point you wish to talk to me, you're always welcome. You can contact me at paul@options21.com.au. That's paul@options21.com.au, and I'm always very happy to communicate with you via email. Thank you.